Imagine a single company that owns a piece of nearly every major corporation on Earth, a firm that whispers in the ears of governments, shapes corporate policy across continents, and manages more wealth than the GDP of every country except the United States and China. This isn't science fiction. This is BlackRock, with over $10 trillion under management. BlackRock has become something unprecedented in human history. Not quite a government, not quite a corporation, but a financial titan whose influence touches your pension, your politics, and your future. But here's the paradox that should keep you awake at night. Is BlackRock the ultimate expression of democratic capitalism, allowing millions of ordinary people to own stakes in global prosperity? Or has it become something far more troubling, a concentration of power so vast that it threatens the very market principles it claims to champion? The answer isn't what you think, and understanding it requires us to journey through philosophy, psychology, and the hidden mechanisms of modern financial power. That question we just posed isn't rhetorical grandstanding. It cuts to the heart of one of the most consequential yet poorly understood developments in modern capitalism. BlackRock manages approximately $10 trillion in assets. To put that in perspective, that's roughly equivalent to half of the entire United States GDP, or more than the combined GDP of Japan, Germany, and the United Kingdom. This wealth isn't sitting in some Scrooge McDuck vaults, actively deployed across global markets, shaping corporate behavior, influencing government policy, and fundamentally restructuring how capitalism itself operates. Yet most people have never heard of BlackRock, or if they have, they don't grasp the philosophical implications of its existence. We live in an age where we debate the power of tech companies, the influence of social media, and the reach of traditional governments, but we largely ignore the quiet titan that owns significant stakes in all of them. This gap in our understanding represents a dangerous blind spot in how we think about power, capital, and democracy in the 21st century. Here's what we're going to explore today. We'll trace BlackRock's meteoric rise from a small bond trading shop to the world's largest asset manager. We'll examine the philosophical foundations and contradictions of stakeholder capitalism that BlackRock's CEO Larry Fink has championed. We'll dive into the psychology of passive investing and how it's reshaping human behavior around money. And crucially, we'll grapple with the economic implications of having such concentrated financial power in an era that supposedly prizes free markets and distributed decision-making. This is the economic philosopher, where we don't just explain what's happening, we ask what it means. So let's begin our investigation into whether BlackRock represents capitalism's finest achievement or its most dangerous evolution. To understand BlackRock's unprecedented power, we need to go back to 1988. The story begins not with grand ambitions of global domination, but with a painful lesson about risk. Larry Fink, a successful bond trader at First Boston, had just experienced a spectacular failure. His division lost about $100 million due to incorrect interest rate predictions. It was a humiliation that would have ended many careers. Instead, it became the catalyst for a revolution in financial management. Fink's insight was deceptively simple, but profound. Wall Street had a risk problem. Firms were making massive bets without properly understanding their exposure. The financial models were primitive, the data was fragmented, and decision-makers were flying blind. Fink envisioned something different, a firm built not on taking risks, but on understanding and managing them with unprecedented precision. In 1988, Fink and 7 partners founded Blackstone Financial Management with $50 million in seed capital, operating under the umbrella of the Blackstone Group. The name would later morph into BlackRock after the firm split from its parent company in 1994, taking the Black from Blackstone and adding Rock to convey stability and permanence. That rebranding was more prophetic than they could have imagined. BlackRock's initial focus was fixed-income institutional asset management. This might sound mundane, but it positioned the firm at the intersection of 2 powerful forces reshaping finance in the late 20th century. First, the explosion of institutional investing as pension funds and endowments grew massive. Second, the increasing complexity of financial instruments following the deregulation wave of the 1980s. BlackRock didn't just ride these waves, it provided the navigational tools. The key innovation was Aladdin, which stands for Asset Liability, Debt, and Derivative Investment Network. Launched in the early 1990s, Aladdin was a revolutionary risk management system that could aggregate data across entire portfolios, stress test positions under thousands of scenarios, and provide real-time insights into exposure. At the time, nothing else came close to its sophistication. Today, Aladdin processes trades worth about 10% of the world's financial assets and is used not just by BlackRock, but by hundreds of financial institutions, pension funds, and even central banks. Think about the philosophical implications here. BlackRock built its empire not by being the best at making bets, but by being the best at understanding risk. This represents a fundamental shift in the nature of financial power. In the era of J.P. Morgan, power came from having access to capital and the courage to deploy it decisively. In BlackRock's era, power comes from having better information and superior analytical tools. It's the difference between the bold sea captain and the master cartographer. Both have power, but of fundamentally different types. The firm's growth trajectory reads like a hockey stick. By the late 1990s, BlackRock was managing tens of billions. The 2008 financial crisis proved a pivotal moment. While other firms collapsed or retreated, BlackRock emerged as the indispensable problem solver. The Federal Reserve hired BlackRock to manage toxic assets from Bear Stearns and Age global banks, turned to Aladdin to understand their own balance sheets. BlackRock acquired Barclays Global Investors in 2009 for $13 billion, instantly making it the world's largest asset manager and giving it control of the iShares suite of exchange-traded funds. Today, BlackRock operates in more than 30 countries, employs over 16,000 people, and touches virtually every corner of global finance. But the numbers, staggering as they are, don't capture the qualitative transformation BlackRock represents. This isn't just a very large investment firm. It's something categorically different, a financial infrastructure company that has become as essential to global markets as operating systems are to computing. The historical arc reveals a pattern that philosophers of technology would recognize. A tool designed to solve a specific problem evolves into a platform that restructures the entire domain. BlackRock started as a better risk management system and evolved into the central nervous system of modern finance. And like any nervous system, it doesn't just observe and report, it shapes behavior and coordinates action across the entire body. Which brings us to our next question. What does BlackRock actually believe in? What philosophy guides this unprecedented concentration of capital? Larry Fink's annual letters to CEOs have become must-read documents in boardrooms around the world. These aren't dry financial communications, but philosophical manifestos about the purpose of corporations in modern society. Starting around 2018, Fink began explicitly championing what he calls stakeholder capitalism, the idea that companies must serve not just shareholders seeking returns, but all stakeholders, including employees, communities, and the environment. This represents a direct challenge to the Milton Friedman doctrine that dominated corporate thinking for half a century. Friedman famously argued that a corporation's only social responsibility is to increase profits within the rules of the game. Any deviation from profit maximization, Friedman claimed, represented a kind of taxation without representation, executives spending shareholder money on their preferred social causes. For decades, this view was virtually scripture in business schools and boardrooms. Fink's stakeholder philosophy sounds noble, even compassionate. He's argued that climate risk is investment risk, that companies must prioritize diversity and inclusion, and that business must address social inequality. These letters have real teeth. BlackRock votes its shares in accordance with these principles, supporting climate-related shareholder proposals and occasionally voting against management at companies deemed insufficiently committed to environmental, social, and governance criteria, commonly known as ESG. But here's where we need to apply philosophical scrutiny. What does it actually mean for the world's largest asset manager to champion stakeholder capitalism? Is this a genuine evolution toward more ethical capitalism? Or does it represent something more complex and potentially troubling? Let's start with the contradiction at the heart of Fink's position. BlackRock is a fiduciary, legally and morally obligated to act in the best financial interests of its clients. These clients are largely pension funds, endowments, and retirement accounts belonging to millions of ordinary people. When BlackRock votes, shares, or allocates capital according to stakeholder principles, it's making a specific claim that considering broader stakeholder interests ultimately serves the financial interests of its clients. This might be true in the long run. Companies that pollute may face regulations and liabilities. Companies that mistreat workers may suffer productivity and reputation problems. Climate change poses real systemic risks to long-term returns. From this perspective, stakeholder capitalism isn't idealism, it's sophisticated self-interest, properly understanding where fiduciary duty leads when you extend your time horizon. But there's a deeper problem that gets to the nature of power itself. Who decided that these particular stakeholder considerations should be prioritized? What democratic process determined that BlackRock's conception of social good should influence thousands of companies? This isn't to argue that climate change isn't real or that inequality doesn't matter. It's to point out that we've essentially outsourced moral and political decision-making to an unelected financial institution whose primary competence is risk management and asset allocation. The philosopher Robert Nozick posed a thought experiment about a utility monster being who derives so much happiness from resources that utilitarian logic would demand we give it everything. BlackRock isn't quite a utility monster, but it represents an analogous concentration of influence. Its stakeholder capitalism initiative might be well-intentioned, even correct on the merits. But the process by which this institution gained the power to reshape corporate behavior worldwide bypassed traditional mechanisms of democratic accountability. There's also a profound irony here that reveals the psychological dimension we'll explore next. BlackRock's growth has been driven substantially by passive index investing, a philosophy that explicitly rejects the idea that active management and stock picking create value. Yet stakeholder capitalism requires active engagement, judgment calls. And the assertion that BlackRock's analysts and executives can identify which corporate policies will create long-term value better than markets themselves. So which is it? Are markets efficient mechanisms that we should trust via passive indexing? Or do they need guidance from enlightened asset managers who can see beyond quarterly returns? This isn't just an academic contradiction. It points to a fundamental tension in modern capitalism between efficiency and agency, between trusting emergent market processes and believing that intelligent design can improve outcomes. BlackRock's philosophy tries to have it both ways, embracing passive investing's humility about outperforming markets while simultaneously exercising active judgment about corporate governance and social responsibility. Perhaps the most generous interpretation is that BlackRock represents a kind of Hegelian synthesis. Passive investing addresses the inefficiency and expense of active stock picking, while engaged ownership through stakeholder principles addresses market failures and externalities that pure passive strategies would ignore. But this synthesis only works if you trust that BlackRock's massive scale, sophisticated analytics, and good intentions translate into genuinely better outcomes. And that brings us to a crucial question about human psychology and behavior in the age of passive investing. The rise of index funds and exchange-traded funds represents one of the most significant psychological shifts in how humans relate to capital and markets. For most of financial history, investing was an active endeavor. You picked individual stocks or bonds, you followed companies, you made decisions. This required attention, knowledge, and psychological fortitude during market swings. Investing was engaging precisely because it demanded engagement. BlackRock's iShares business, managing nearly $3 trillion in ETFs, has been instrumental in transforming this landscape. Today, an investor can gain exposure to thousands of companies across dozens of countries with a single transaction, requiring no more thought than buying a sandwich. The psychological implications of this frictionless diversification are profound and largely unexamined. First, consider what behavioral economists call the paradox of choice. When confronted with too many options, humans often make worse decisions or freeze entirely. Barry Schwartz documented how excessive choice leads to anxiety, regret, and diminished satisfaction. Index funds solve this problem by essentially removing choice. You don't pick, you buy the market. This elimination of decision-making is simultaneously liberating and concerning. It's liberating because it protects ordinary investors from their own psychological biases. Humans are terrible at timing markets. We buy high when euphoric and sell low when panicked. We anchor on irrelevant numbers and fall victim to confirmation bias. The evidence is overwhelming that most active investors underperform simple index strategies after accounting for costs and behavioral mistakes. By automating diversification and removing the ability to tinker, passive investing functions as what Daniel Kahneman might call a cognitive prosthetica tool that compensates for inherent limitations in human decision-making. But it's concerning because it represents a kind of learned helplessness about understanding markets and companies. When you invest in an S&P 500 index fund, you're not actually making any claims about which companies will succeed. You're making a metaclaim that the aggregate judgment of all market participants will produce reasonable returns, and that trying to beat that aggregate isn't worth your time. This might be rational, but it also represents a retreat from economic citizenship. You become a passenger rather than a participant, which fundamentally changes your relationship to capitalism. This psychological shift has second-order effects that compound. When millions of investors embrace passive strategies, price discovery, the process by which markets incorporate information into valuations, increasingly depends on a shrinking pool of active investors. It's a free rider problem of the first order. Passive investing only works because some investors are still doing fundamental analysis, pricing assets, and allocating capital based on research. But as passive investing grows, who's left to do that essential work? There's also a deeper existential dimension. Humans derive meaning from agency, the sense that our choices matter and shape outcomes. Traditional investing, for all its flaws, provided a narrative of personal financial agency. You researched, you decided, you succeeded or failed based on your judgments. That narrative is deeply embedded in the ideology of American capitalism and the Protestant work ethic that Max Weber documented. Passive investing severs this connection. Your wealth grows or shrinks based on forces entirely beyond your control or comprehension. You're urged to stay the course and ignore volatility, in other words, to suppress the very psychological engagement that once defined investing. Now, BlackRock would argue that this is precisely the point. Emotional detachment leads to better outcomes. Don't let fear or greed derail your long-term plan. But there's a difference between emotional regulation and emotional disconnection. The passive investing ethos increasingly resembles what Bung-Quellhan calls the burnout society, a therapeutic approach that treats engagement itself as the problem rather than addressing the underlying structural issues that make engagement fraught. Here's the even more troubling psychological transformation. Passive investing changes how we think about corporate governance and accountability. When you own individual stocks, you have some psychological ownership of corporate behavior. If a company you hold does something unethical, you feel complicit and might divest. But when you own index funds, every company is effectively the same, just a line item in a vast portfolio. You can't be boycotted because you own everything. You can't signal values through investment choices because you're forced to own both saints and sinners. This is where BlackRock stakeholder capitalism becomes psychologically significant again. In a world where individual investors have delegated both security selection and governance engagement to massive asset managers, those asset managers become the de facto conscience of capitalism. BlackRock voting its shares on climate or social issues isn't just corporate policy. It's a kind of outsourced morality for millions of passive investors who've lost the ability to express preferences directly. The psychological contract is this: you give up agency and engagement in exchange for better returns and fewer headaches. BlackRock and similar firms promise to exercise that delegated agency wisely on your behalf. But this arrangement depends entirely on trust that BlackRock's interests align with yours. Trust that its analysis is sound, trust that its values represent your values. And increasingly, we're seeing that trust questioned as people wake up to the implications of this bargain. The psychology of passive investing also intersects with broader trends toward algorithmic decision-making and predictive analytics. Just as Netflix tells you what to watch and social media algorithms curate your information diet, financial technology increasingly tells you how to save, invest, and allocate. The pattern is the same. Surrender judgment to superior computational power and data. This might optimize for narrow metrics, but it atrophies the very capacities critical thinking, independent judgment, tolerance for uncertainty that define human agency. So we're left with a psychological landscape transformed by BlackRock and firms like it. Investing has shifted from active participation to passive optimization, from narrative agency to statistical inevitability, from individual responsibility to delegated governance. Whether this represents progress or impoverishment depends on what you believe humans are for. Are we primarily pleasure-maximizing utility seekers who should minimize effort and maximize returns? Or are we meaning-seeking beings who need engagement, agency, and the psychological satisfaction of participation, even when it's economically suboptimal? This question isn't academic. It shapes everything from retirement security to political economy, and it brings us to the final dimension. What does BlackRock's power mean for economic systems and structures? Let's address the central economic question. Is BlackRock's concentration of assets and influence good or bad for capitalism? The answer requires us to distinguish between several different dimensions of market health and social welfare. Start with market efficiency in the narrow sense. There's substantial evidence that BlackRock and similar large asset managers contribute to pricing efficiency. They invest heavily in research and analytics. Their trading is generally informed by fundamental analysis rather than panic or speculation. They provide liquidity in many markets and have stabilizing effects during periods of stress. The 2008 financial crisis might have been worse, without sophisticated actors using tools like Aladdin to understand interconnected risks. From this perspective, BlackRock represents capitalism, working as intended, rewarding competence and specialization. But now consider market structure and competition. The asset management industry has consolidated dramatically. BlackRock, Vanguard, and State Street, the big three. Passive asset managers collectively own significant stakes in virtually every large public company. Research by Jose Azar and others has documented that when the same institutional investors own competing companies in an industry, so-called common ownership can reduce competitive intensity. If the same investors own United, Delta, and American Airlines, they don't benefit from those airlines fiercely competing for market share, since any gain for one comes partly at the expense of the others. The mechanisms are subtle. It's not that BlackRock explicitly tells airlines to avoid competing; that would be illegal. Rather, common ownership changes the incentives for corporate managers. If a CEO knows her compensation depends partly on stock price, and the same investors who own her company also own her competitors, actions that boost industry profitability even at the expense of her company's market share might be rewarded. The empirical evidence here is contested, but the theoretical concern is real. Concentrated passive ownership might inadvertently dampen the competitive dynamics that make capitalism productive. There's also the fundamental question of whether capital markets can function properly when ownership is this concentrated. Stock prices are supposed to reflect the aggregated judgments of diverse investors with different information, time horizons, and beliefs. This diversity is what makes markets effective information processing systems, as Friedrich Hayek argued. But when a handful of asset managers control such a large percentage of shares, we lose some of that cognitive diversity. BlackRock, Vanguard, and State Street might use different analytics, but they share similar institutional imperatives and professional culture. Think of it as an epistemic monoculture. When everyone is trained by the same MBA programs, uses similar quantitative models, and operates under similar regulatory constraints, the potential for systemic blind spots increases. This isn't about intelligence. BlackRock employs brilliant people. It's about the limits of homogeneous perspective. No matter how sophisticated, the 2008 crisis partly resulted from everyone using similar risk models that all failed to anticipate the same scenarios. Concentration of assets in similar institutional structures recreates this vulnerability. Now, consider the implications for corporate governance and capitalism's broader social contract. Public corporations have dispersed ownership specifically to separate ownership from control. Shareholders own the company, but professional managers run it. This separation was supposed to enable efficient scale while preventing any single investor from dictating corporate decisions. But when BlackRock owns 5 to 7% of a major corporation and Vanguard owns another 5 to 7% and State Street owns another 5%, that dispersed ownership starts to look more concentrated than it appears. The big three together often control 15 to 20% of voting shares, and they frequently vote as a bloc. That's effective control in most situations, since other shareholders are too dispersed to coordinate. This concentration recreates some of the accountability problems of earlier corporate forms, but without clear lines of responsibility. At least in the past, when J.P. Morgan controlled U.S. Steel, everyone knew who was making decisions. Today's diffuse, yet concentrated ownership through index funds creates governance power without visible governance authority. BlackRock can claim it's just following index mandates when convenient, yet asserts stewardship responsibilities when that serves its interests. It's a form of power that escapes traditional accountability mechanisms. The economic implications extend to political economy and inequality. BlackRock has made billions in profits while managing trillions for clients. This seems reasonable. They provide a valuable service and charge modest fees by historical standards. But those modest fees, applied to vast assets, generate enormous revenues. BlackRock's market capitalization exceeds $100 billion. Larry Fink's personal wealth is measured in hundreds of millions. The irony is that BlackRock's business model depends on arguing that active management doesn't work and can't justify its fees. Yet BlackRock itself extracts billions annually from passive management. More broadly, the growth of asset management benefits those who have assets to manage. If you have substantial retirement savings and can access low-cost index funds, BlackRock's services are genuinely valuable. But if you're living paycheck to paycheck with minimal savings, the rise of sophisticated asset management is largely irrelevant to your economic well-being. In this sense, BlackRock's success story is part of the broader pattern of returns to capital outpacing returns to labor that Thomas Piketty documented. The financialization of the economy enriches those with financial assets, while doing little for those whose economic participation is primarily through wages. There's also the question of systemic risk. BlackRock is now too big to fail in ways that matter more than traditional banks. If BlackRock's Aladdin system experienced a catastrophic failure, a cyber attack, a critical software bug, a cascade of errors, the impact on global markets could be devastating. Hundreds of institutions rely on Aladdin for risk management and trading. Central banks depend on it for understanding financial stability. BlackRock has effectively become part of financial infrastructure, but it's a private company optimizing for shareholder returns, not a public utility operating for stability. The Federal Reserve and other regulators are beginning to grapple with this reality, but the solutions aren't obvious. You can't easily break up an asset manager since the assets belong to clients who can withdraw them. You could regulate more stringently, but that might just entrench incumbent advantages. You could try to foster more competition, but scale advantages in asset management are substantial. Bigger firms have better data, more sophisticated tools, and lower unit costs. The economic dynamics naturally push toward concentration. Finally, we need to consider what BlackRock's model means for capitalism's future. We're moving toward a system where capital allocation is increasingly algorithmic and concentrated, where governance is exercised by a small number of professional asset managers rather than diverse owners, and where market participants are increasingly passive passengers riding algorithmic waves. This might be more efficient in certain respects, but it represents a fundamental transformation of how capitalism functions. The original vision of shareholder democracy imagined thousands of active investors monitoring companies and voting with their feet and their shares. That vision is effectively dead. The new reality is a kind of professional capitalism, where expert intermediaries control the commanding heights of the economy. This isn't inherently bad, but it raises questions about who guards the guardians and whether efficiency gains are worth the concentration of power. Let's pull together what we've learned. BlackRock's rise from risk management startup to $10 trillion titan tells us something crucial about power in modern capitalism. Traditional power was visible. Monopolists controlled markets. Tycoons owned railroads. Banks held capital. Contemporary financial power is more diffuse and harder to grasp. BlackRock doesn't own most of what it controls. It manages assets belonging to millions of people and institutions. Yet that management role confers enormous influence over corporate behavior, market dynamics, and even political economy. The philosophical contradictions are real. Stakeholder capitalism, as articulated by Larry Fink, represents either an evolution toward more sustainable and ethical business or a troubling concentration of moral authority in unelected institutions. The answer probably contains elements of both. BlackRock's engagement on climate and social issues might drive genuinely positive change, but the process by which a financial institution gained this influence bypassed democratic deliberation and depends entirely on BlackRock's judgment, remaining aligned with social welfare. Psychologically, the shift to passive investing has fundamentally altered how ordinary people relate to capitalism. The benefits are clear better returns, lower costs, reduced anxiety. But we've also surrendered agency, engagement, and the psychological satisfaction of economic participation. We've become passengers in a vehicle whose destination and route are determined by algorithms and professional managers. This might optimize wealth accumulation, but it raises questions about meaning, purpose, and democratic citizenship. Economically, BlackRock's concentration of assets creates both efficiencies and risks. Markets might price assets more accurately, but they lose cognitive diversity. Corporate governance has professional oversight, but accountability becomes murky. The system serves those who have capital to invest, but does little for those who don't. And we've created new systemic vulnerabilities in the form of infrastructure dependencies on private firms. So what does this mean for you? First, recognize that your relationship to capitalism has likely shifted without your full awareness. If you invest in index funds, you probably should have delegated not just security selection, but governance and values expression to asset managers. Understand that trade-off. You're getting convenience and likely better returns, but you also accepting that institutions like BlackRock will exercise judgment on your behalf about corporate behavior and social priorities. Second, demand transparency and accountability from asset managers. BlackRock publishes its voting records and stewardship reports. Read them. Understand how your capital is being deployed beyond just returns. If you disagree with how BlackRock votes, shares, or engages with companies, consider whether there are alternative funds that better align with your values. The growth of ESG and impact investing provides more options than existed a decade ago, though you'll need to scrutinize whether those options represent genuine differences or just marketing. Third, recognize the broader political economy questions at stake. The concentration of financial power in a few large asset managers is a policy choice, not an inevitability. Different regulatory frameworks, tax policies, and market structures could foster more diverse ownership models. Worker ownership, stakeholder governance, and public banking are all viable alternatives that distribute power differently. These aren't fringe ideas. Countries like Germany have substantially different ownership patterns that shape corporate behavior quite differently from the Anglo-American model. Fourth, don't assume that efficiency and optimization should be the only metrics. The push toward passive investing makes sense for individual returns, but what's optimal for individuals might create collective problems. Sometimes friction, inefficiency, and human judgment serve important functions. Markets need active participants to function properly. Democracy needs engaged citizens, not just optimized consumers. Think about whether and where you want to maintain agency, even when it's economically suboptimal. Finally, grapple honestly with the paradox at the heart of modern capitalism. We supposedly prize free markets, competition, and distributed decision-making. Yet we've created structures of concentration in technology, media, retail, and now finance that centralize power to an extraordinary degree. BlackRock is a symptom, not the disease. The disease is a political economy that consistently prioritizes scale efficiency over resilience, shareholder returns over stakeholder welfare, and professional expertise over democratic input. The question posed at the beginning was whether BlackRock represents capitalism's achievement or its danger. The answer is that it represents both, which is precisely what makes it philosophically and politically challenging. BlackRock provides genuine value, better risk management, lower investment costs, engaged corporate oversight, but it also concentrates power in ways that create new vulnerabilities and accountability gaps. The task isn't to demonize or celebrate BlackRock, but to understand the trade-offs its existence reveals about how we structure economic life. Here's what I want you to do. Think about your own investments and whether you actually understand where your money is and how it's being used. If you own index funds through BlackRock or any other asset manager, spend time looking at their voting records and engagement reports. Decide whether their approach to stakeholder capitalism aligns with your values. If it doesn't, explore alternatives. More broadly, I want to hear from you. Do you think the concentration of financial power in firms like BlackRock is a problem that requires policy intervention? Or do you believe the benefits of efficient capital allocation outweigh the risks of concentration? Are there models of ownership and governance you think we should be exploring? Share your thoughts in the comments. This channel thrives on substantive discussion, and these questions don't have easy answers. If you found this analysis valuable, subscribe to The Economic Philosopher and turn on notifications. We're going to continue exploring the hidden structures that shape modern capitalism, from algorithmic trading to modern monetary theory to the philosophy of work in an age of automation. Each video goes deep, blending history, philosophy, psychology, and economics to understand not just what's happening, but what it means. And check out the video we did on sovereign wealth funds. And how nations are becoming investors connects directly to many of the themes we explored today about power, capital, and governance. Or watch our deep dive into behavioral economics and why humans make terrible financial decisions, which provides more context for understanding why passive investing became so dominant. This has been The Economic Philosopher, where we don't just explain the economy, we examine the ideas that shape it and what those ideas reveal about power, human nature, and the kind of society we're building. Thanks for thinking deeply with me today. Until next time, stay curious, stay critical, and remember that understanding power is the first step toward shaping it.